This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the third and the final lecture on chapter 17 of the free paper F2 lecture notes, and it's on budgeting. Now, in the first lecture, I talked about what we meant by budgets, what the potential benefits are of budgeting. And then in the second lecture, we looked at an example and prepared some functional budgets. In this, the last lecture, we're looking at what we call types of budgets. And you will see in section 6 of the chapter, there's a list there: fixed budget, flexible budget. Well, I will come back and write down what you might call a definition of each of them. But before I do, to make sense, to explain what they are, can you turn to example 2 on the last page of the chapter? Have a quick look with me. It says a company has prepared the following fixed budget for the coming year. They were budgeting on sales of 10,000, production of 10,000. We're told there what the costs were of materials, labour, variable, fixed overheads, and what the budgeted selling price was. So we've got the budget information there, and below it tells us what actually happened. We actually produced 12,000, the actual cost of materials was 60,000, and so on. Well, let's first of all set up or write down the fixed budget. And although I'll explain why it's called the fixed budget later, this is the original budget. So the fixed or original budget. And just so I don't get lost later on, remember in the original budget we were budgeting on sales of 10,000 units. We were budgeting on production of 10,000 units, a nice easy one. But let's write up a budget profit statement. So the profit statement, the sales revenue, it says the selling price was $10 a unit. And so 10,000 units in the budget, we were budgeting on revenue of 100,000. What about the costs? Well, we're told directly the materials, a cost of 50,000. Labour, the budget cost was 25,000. Variable overheads, a budget cost of 12,500. And finally, fixed overheads, a budget cost of 10,000. So the total budgeted costs, 75, 85, 90, well, it's there anyway, 97,500. And so the budget profit, 100 revenue, 97,500 costs, a budgeted profit of 2,500. No problem. However, one reason I gave in the first lecture, one benefit potentially of doing budgets, is that we can then measure the performance of our managers by comparing what actually happened with what was budgeted. And so, for example, if you look at the second bit of the question, it tells us the following costs have been incurred. It says materials 60,000. And of course, the actual materials, 60, we budgeted on 50. It looks as though something dreadful has gone wrong. We've spent far more than we should have done. Except, of course, it would be ridiculous to start blaming the manager responsible for having spent so much more. Obviously, we spent more. And why? Because we actually produced more. It says at the end of the year, the following costs have been incurred for the actual production of 12,000 units. Well, obviously, if you produce more units, you'll expect to spend more. And it's not the manager in charge of materials, it's not their fault that we produced more units. Of course it isn't. But as a result, it would be ridiculously unfair to compare the 60,000 we actually spent with the 50 that was in the budget. And if we want to make a sensible measure, a sensible comparison, we should work out, given that we produced more units, how much then would we have expected to spend, and then compare that with what we actually spent. And so if we're going to use it for measuring performance in that way, for controlling, we need to rewrite the budget and say, well, given that we actually produced 12,000, what would we have expected to happen? And what it says later on, we sold 12,000. So the actual sales were 12,000 units. The actual production was 12,000. Before we do any more, let's rewrite the budget and say, if we'd have known we were going to produce and sell 12, fine, what would have been the figures? Well, sales, of course, should be at $10. And so how much would we have budgeted on? 12,000 units at $10, revenue of 120,000. What about the costs? Well, the original budget was 50,000, materials, was 50,000 for 10,000 units, which was $5 a unit, 50 divided by 10. Given that we produced 12,000 units, surely at $5 a unit, you would have expected to spend 12,000 at 5 is 60. Well, what about labour? We originally budgeted on 25,000, expecting to produce 10,000. So we were expecting it to be $2.50 a unit. We actually produced 12,000, and at $2.50, we'd now be expecting to have spent 30,000. What about variable overheads? Again, we budgeted on 12,500, 10,000 units. We were expecting it to be $1.25 a unit. Well, for 12,000 units, we'd now be expecting it at $1.25 to be 15,000. Fixed overheads, of course. Fixed overheads shouldn't change with the level of production, whether we produce more or less. They should stay fixed at 10,000. And so even though we did produce more units, you'd still be expecting them to be 10,000. Incidentally, it does say at the bottom we're using a marginal costing approach. You'll see later when we come to a chapter called Variances that if we were using absorption costing, we could have a bit of messing around there. But here, no problem. But as a result, for our actual level of activity, for the 12,000 we actually produced and sold, we'd expect the total costs, in fact, to be 60, 90, 105, I think 115,000. And as a result, the profit we'd now be expecting, 120 less 115, would in fact be 5,000. Now, why have I done that? Because in a minute, it is now fair to compare materials again, what we actually spent with what we should be spending. We've rewritten the budget for the actual activity, the actual production, actual sales, and that's called a flexed budget. And again, we now can compare the actual results. We actually did sell 12,000, obviously, we did produce 12,000. But what actually happened? First of all, the sales. It says at the bottom we sold 12,000 units, fine. We sold them for 122,000. So we actually did well. You know, for the 12,000 sold, we only expected to get 120. We got 122. I think clearly we put the price up a bit. We got an extra 2,000. That difference we call a variance. We say with a variance of 2,000, we got 2,000 more than we expected. We've obviously sold at more than $10. That seems quite good. Also, of course, these differences, it could be good, it could be bad. Here it's good because if we've got more revenue than we expect, that by itself will give us more profit, surely. Well, if we'd have got less than we'd expected, then it would give us less profit. Well, because this is good, it gives us more profit. We write against it the letter F. F stands for favourable, which is more profit. Let's look at the costs. The actual cost of materials was 60,000. And as I was saying earlier, to have compared it with the original 50 would be silly. For our level of production, we expected to spend 60. We have spent 60. There's no variance. The manager has done what you might call a perfect job. What about labour? We actually spent on labour 28,500. Again, it's more than the original budget. Of course it's more because we produced more. And in fact, we would now have expected to spend 30 and we only spent 28.5. The difference, 1,500. And surely that's good. We've saved. And if the cost is lower than you expect, the profit would be higher. Again, it's favourable. Whoever's in charge of labour has actually done a good job, perhaps deserves a bonus. They spent less than we would actually have expected. What about variable overheads? We actually spent 15. No variance. That's exactly what we should have expected. Finally, fixed overheads, we spent 11. We should still only have spent 10. The difference is 1,000. And surely this time, because we spent more than we'd expect, if you spend more than expected, it'll mean less profit. Well, if it's less profit, we don't put minus signs or anything. We put the letter A. A stands for adverse, which means less profit. And let's tidy it up. First of all, what was the actual profit? Well, the actual costs are 60, 88.5. Oh, I'll use my calculator. The actual costs total 114,500. And so the actual profit, 122 minus 114,500, is 7.5. Now, of course, management are going to want to know, why was the actual profit different than from what we budgeted? We budgeted on 2,500. How have we managed to make 7,500? Well, the first reason is we sold more units. And so immediately we expect more profit. We expect an extra 2,500 because of selling more units. Fine. Had everything gone perfectly in terms of the standard costs, the profit would have been 5 now. So why is it 7.5? For these 3 reasons. We gained on the sales, we gained on labour by spending less, we lost a bit on fixed overheads. And as a check, the total of those, 2,000 favourable, 1,500 favourable, 3.5, less 1,000 adverse, there's a net 2,500 favourable. And of course that does explain the extra profit. And that's what will interest management. Management aren't so much concerned with the final figure, 7.5. They're concerned, why is it different than what we budgeted? Again, an extra 2.5 because we sold more. An extra 2,000 because we had a higher price. An extra 1,500 because the materials manager saved us a bit of money. And lose 1,000 because whoever's in charge of fixed overheads for some reason has overspent. Now that was a very, what you might call, simple example. These variances, it becomes a huge topic in a later chapter where we need to investigate, that labour. How did we come to spend more or less? So less in this case. There are various different reasons. So you will see in a later chapter there's an awful lot of work we need to do. But the main reason for what I've done here was to explain the relevance of a flexed budget and what it is. So I hope it's clear why we need to flex it if we're using budgets as a way of measuring performance. And having explained that, if you want to go back to the previous page and fill in what they are, the fixed budget, that's the original budget. One relevance of it is it always remains the overall target. Here we originally budgeted on 2.5. As it turns out here, we're actually doing a lot better, but we could be doing worse. But whatever happens, the overall target is to make at least 2,500. If we can do better, great. If we're doing worse, we want to try and sort it out. The flexed budget, I hope now is perfectly clear. It's where we rewrite the original budget for the actual level of activity, and by that I mean actual sales, actual production. And the relevance of it, again, I do hope is now clear. The relevance is that we use it for control. We compare actual with the flexed budget. And in fact, as you'll see when we come to variances proper later, this is usually done monthly, so that if we do find something's going wrong in January, we'll find out what went wrong and we'll try and see if we can correct it for February. Finally, flexible budget. Generally speaking, means the same as flex budget, to be honest. Strictly what it is let me write and then explain. It's we prepare the budget in a way that can be easily flexed. What I mean by that is, I think you'll have appreciated in that previous example, variable costs, if you produce more, you'll expect to spend more. Fixed costs should stay fixed. So we do need to have our variable and fixed costs identified separately. And you'll remember from earlier chapters, a lot of costs are semi-variable, they're part fixed, they're part variable. Well, if we're going to be flexing, we need to make sure we have separated out, that we know exactly what the variable costs are per unit and we know what the fixed costs are per month or whatever the period is, in order for it to be easy to be flexed. We say then we've got a flexible budget. So there we are. It took me a while because I went further than we actually needed, to explain the flexed. But that bit about variances, I've already said there's a lot more work involved in a later chapter, but there's a brief introduction. Variances are the difference between actual and flexed budget. And that, I'll remind you again when we come to the chapter, but that bit about F and A, if the difference is good, that means more profit, it's favourable. If the difference is bad, we've overspent less profit, it's adverse. Okay.